Takeaway from Coffee Can Investing by Saurabh Mukherjee and Rakshit and Pranab. It is critical for an investor to nail down objectives and bake them into a financial plan and apply it to portfolio. It is important to not adhere to the age-old wisdom of investing heavily in fixed deposits, real estate and gold. These assets have underperformed equity by significant margins over long periods of time. In fact, these assets have often given returns lower than inflation over long periods of time and thus damaged investors' wealth. Equity remains the most powerful driver of long-term sustainable returns. However, investors need to be patient and systematic with equity investments. They also need to keep their brokerage and financial intermediation fees low. Chapter 2: Coffee Can Investing. Intermediaries make equity investing a complicated affair. Our learning from legendary investors like Warren Buffett, Akash Prakash, Sanjoy Bhattacharya and K.N. Sivasubramanian is that, to consistently generate healthy returns from equity investing, one has to invest in high-quality companies and then sit tight for long, often very long, without losing sleep about where the share price is going. The Coffee Can portfolio of great companies. Author: look for companies above 100 crore Indian rupees market capitalization, which over the preceding decade have grown sales each year by at least 10% alongside generating return on capital employed, pre-tax, of at least 15% each year. Detailed back-testing of the Coffee Can portfolio in India, based on data going back to 1991, shows that such a portfolio beats benchmarks across all time periods. Chapter 3: Expenses Matter. Fund expenses are often ignored but are deceptively important. Given their compounding over long periods, they have the ability to drag down investor returns drastically. Below picture shows difference in return towards 2.5% vs 0.1% expense ratio. Unlike earlier years, the alpha, or outperformance, in large-cap equity mutual funds is now negligible. In this scenario, it makes much more sense to invest in passive funds or ETFs. Already, in the US, active funds have started seeing massive outflows, which are becoming inflows for passive funds. A broker suggesting funds to an investor leads to a conflict of interest. Driven by SEBI, the country has already moved on to an only advisory, or only broking, model. Chapter 4: The Real Estate Trap. In India and developed markets, real estate has given far lower returns compared to equity over long periods of time. Real estate is the most illiquid asset with the highest transaction costs, which are now in excess of 10%. Furthermore, unfavorable taxation compared to equities make it even less desirable for investment. India has had a once-in-a-lifetime bull run in real estate between 2003 and 2013. Most of the people in this era got a solid confidence on real estate, hence they are expecting it to continue further. Chapter 5: Small is Beautiful. Over the past 2 decades, small caps have outperformed large caps in most large stock markets. There are 2 key drivers of this outperformance. Smaller companies have the potential to grow their profits much faster than large companies, and, secondly, as small companies grow in size, they are discovered by the stock market. That is to say, successful small caps gradually attract more research coverage from brokerage analysts and thereafter attract more interest from institutional investors with deep pockets. Ever since the NDA-led government launched its multi-pronged attack on black money in India, 2015, affluent Indians have diverted savings away from real estate, black money, and towards the financial system. This deepening of the financial markets is helping reduce the cost of capital in India, which in turn benefits smaller businesses disproportionately, relative to large household names that dominate the stock market. Whilst the scope for generating superior long-term investment returns is greater with small caps, the need for professional help is disproportionately greater. This is because small companies are riskier than the larger ones due to both fundamental as well as non-fundamental reasons. The good news is that the Indian fund management community now offers several high-quality small-cap and mid-cap funds. Chapter 6: How Patience and Quality Intertwine. Patience premium in equity investing. Stock holding periods less than 1 year are likely to believe that, more often than not, people lose money in equity markets. For stock holding periods greater than 1 year, The Sensex's return over the past 26 years suggests that as the investment holding period increases from 1 year to 10 years, the investor's position on a risk-reward matrix moves from high-risk low-return to low-risk high-return. Quality premium in equity investing is higher for shorter time periods. Let us assume that the quality of a stock is defined as the quality of its returns profile, healthy and sustainable being better than weak and unsustainable. Intuition suggests that shorter investment horizons are akin to speculative investing, where investors do not need to focus too much on the quality of the company to generate good returns. Combining quality premium with patience premium. Whilst both the Sensex and the Coffee Can portfolio, CCP, produce better returns, alongside lower volatility, if held longer, the CCP beats the Sensex by a wide margin when it comes to producing superior returns, with its volatility being even lower than that of the Sensex. Chapter 7: Pulling it all together. 1. Create a financial plan which helps you deliver on your life goals. Unless you do so, you will be shooting in the dark. A financial plan helps you quantify and rationalize your life goals. It also helps you set up a return expectation from your investment portfolio so that you can build an appropriate portfolio with just the right amount of required risk. No more, no less. There are two key drivers of this outperformance. Smaller companies have the potential to grow their profits much faster than large companies, and, secondly, as small companies grow in size, they are discovered by the stock market. 3. Understand the power of high-quality investing and patience. There is an inherent volatility in the equity markets. To exit at the first sign of volatility or trying to time the market will rob you of an opportunity to derive handsome long-term gains. Also, given the long-term tenures of such investments, it is critical to choose only the highest quality investments.